Welcome to the first class of your financial accounting. Today we are going to start with the introduction to financial reporting, and this will be our today's topic. And at the end of the previous recording, we talked about the accounting in a very basic manner. I gave you the example that your parents are asking you to run the household in terms of buying the grocery, paying the bills, refueling the car. So these are all the things their parents ask you to do that with the money they have given you in a month. Okay. So we will continue with the same example and we will start seeing the financial reporting here. In the financial reporting, we will obviously start with the detailed concept of your accounting. Okay. Now, we have established that from our previous discussion that whenever the transaction occur, you are supposed to record that on a daily basis. Okay. Or whenever the transaction happens. And after your transaction has been recorded, after a certain period of time, you need to summarize those transactions in a categorized form for the interested parties. And in our example, the interested parties were your parents. Okay. So what we are doing in financial accounting, we are recording the financial transactions and summarizing them as per the category in a report form or in a statement form for the interested parties, for the parties who has the interest in your recording and summarizing and how well you have performed during that certain period. So financial accounting is recording the transactions on a daily basis or whenever they occur and summarizing those recordings in a statement form. So we have established that the financial accounting is a process of recording the financial transaction and summarizing them in a form of statement. So there are different types of financial statements. Okay, these financial statements are the summary of categorized form of financial transaction you have recorded over a certain period of time. The first financial statement is statement of profit and loss. Now, statement of profit and loss, as the name indicate, it is about profit and loss. Okay. Now, in order to understand the profit and loss concept, I will ask you to take a very basic example. For example, you have bought a laptop for £5,000 and after a use of 2 years, you are going to sell it out. Now, there can be two situations that can happen at that time when you are selling that used laptop. One is either you are going to get the money over your cost, mean in surplus of your cost or in addition to the cost. For example, you have bought £5,000, you are now selling it at £7,000. The other scenario can be you have bought it for £5,000, now its value at £3,000. So in one scenario, you are getting a surplus 2,000 cash over your cost, and in other scenario, you are getting a 2,000 loss or deficit over your cost. Okay, so in one scenario, you have a surplus cash, which is your profit, and in one scenario, you have a deficit cash, which is your loss. So statement of profit and loss indicates in a certain period of time, whatever business has earned in terms of cash and whatever business has paid in terms of cash, this is the net of profit and loss, surplus and deficit, and this statement tells you that. Okay. Okay, the other point which I need you to remember here is whenever you are talking about statement of profit and loss, you are considering all the cash you have received or all the things you have paid. So it will always be statement of profit and loss for the period, for the whole period you are considering right now. For the whole period you are summarizing at the end of the certain period. Okay. Okay. The next one is statement of financial position. Now, if we are talking about the financial position, or I must say the other word is what you own and what you owed. These are two things. Own mean what are the things which are under your ownership or which are under your name or which you have in your custody. For example, your car, your house, your laptop, your mobile. And owed mean whatever you have to pay or whatever you have a liability or whatever you supposed to pay to the bank if you have taken a loan, to a credit card company if you have used their card, or to your friend and family if you have taken money from them. Okay, so when I say your financial position, you must say these are the things which I own, and this is the thing which I need to pay to the people or to the institute to settle my liability or obligation. Okay, so financial position is what you own and what you owed at a particular time. Okay, this is the point you need to remember. At a particular time mean as at a particular date at a particular time. So for example, if you are supposed to give bank a 10,000, your outstanding loan is 10,000 pound, so maybe after a month or after 6 months it will not be 10,000 pound. You are giving them a monthly installment, you are paying them monthly installment. So whenever the statement of financial position we are talking about, it will be at a certain date. So it will be always as statement of financial position as at. Okay, the next statement is statement of changes in equity. Now statement of changes in equity, the equity definition we will see in after a few slides. Equity, for the timing, you can say that it's an amount given by the owner to the business. Okay, and it is sometimes referred as capital. So this statement of changes in equity will tell us how many fund the owner has given the company or the business, and what are the changes happened during the year. So this statement of changes in equity will tell you what money the owner has given you at the start of a certain period and what money you have at the end of a certain period. Then we have statement of cash flow. Now, statement of cash flow means whatever cash inflows and outflows you have in during the period. Okay. Now, normally the period we are talking about is in financial accounting, it is always annual. In majority of the chances, it is annual, 12 months. But it can be 1 month, it can be 6 months, depending upon what type of business you are running. What type of business we are running, we will see that in a short while. What are the different types of businesses we have? And then you have statement of notes to the accounts. Now this statement is, you have four statements: statement of profit and loss, financial position, changes in equity, and cash flow. In these statement, you are writing all the categorization or all the items in a single row. So if you want to give the detail about any row, you are not supposed to do that on the face of the statement. You are going to give that detail into the notes to the account. So what happened is that, for example, you are saying this is the loan outstanding for the business. So loan will have a one, two numeric reference, and that numeric reference you will see into the notes to the account if you want to see the detail of that. Okay, so these are the five financial statements whenever you are doing financial accounting for any businesses after a certain period of time, which is annual or 12 months in majority of the stances. Then you are summarizing that financial accounting or financial transaction into these five financial statements. Okay. Okay, so let's have an overview of what we have talked about so far about the financial accounting. Financial accounting has two parts in it. Number one, recording. Number two, summarizing. And summarizing for what, in what statement? You have five financial statement. Again, profit and loss, financial position, changes in equity, cash flow, and notes to the accounts. Okay, so in financial accounting, you recording, summarizing in five financial statements for who? For the interested parties who have given you the money, or maybe they are interested for any other motives as well. There is one more accounting is management accounts or management accounting, which also done after the summarizing part, but it is used internally. Okay, but we will see that after few slides what the management accounting is. Okay, now stakeholders type. Who are stakeholders? Stakeholders are those people who has a direct interest in the performance of your business, in the figures of your business, in the financial statements of your business. Okay, they want to know how well you are performing. Why? They have their own motives, they have their own reasons. Okay, we will see that those reasons. What are these reasons? But in the categorization of stakeholders, there are two categories. One is called internal, and the other one is called external. Okay, internal stakeholders within the business, external stakeholders outside the business. Okay, so internal stakeholders are those stakeholders which exist within the business, and external stakeholders are those stakeholders which have an interest in your business but they are sitting outside the business. Okay, okay, now let's see what are the stakeholder types we have. Number one, we have suppliers. Suppliers are external stakeholders, and why they are interested in your business? Because they are giving you the maybe they are giving you goods on credit. Now, on credit goods means you are receiving the goods today, but you are supposed to pay the supplier after a certain period, maybe after 1 month. Okay, so that period in which you are receiving the good and the payment date, the in between days of period is called credit period. Okay, so it can be 10 months or sorry 10 days, it can be 15 days, it can be 1 month, depending upon what are the condition or agreement you have done with your supplier. Okay, so if the supplier is providing you good on credit for a month, he has to wait for the payment, so he has to have some surety that you are going to pay him. Okay, so supplier is interested why your business is doing good, because they want to know the financial health, because they are providing you goods on credit and you will be able to pay that amount against those goods which have been delivered at the start of the credit period. Okay, the second external stakeholder is customers. Now, why customers are interested in your business? Okay, it can be, your customer is interested whether you are supposed to be providing these goods over a longer period or over a shorter period. Obviously, if you know one company or one business is going towards the closure or it will not be in operation next year, you won't buy their product even though there is no after sale services involved. But you have a, you will not be more comfortable in buying the goods from a company which will be closed after 1 year. So as a customer, you need to know that the product they are making, they will be, in operation in a longer run, so that you can have the product again if the product get defected or lost. The other thing, why customer needs to know that you are going to be in operation, maybe you are dealing in a specialized equipment. Maybe you are making engines for a Boeing, or maybe you are making jet engines for any aircraft. So if you are a specialized, you have a specialized supplies business, then the customer is dependent upon you because you are the only person in the world making it. So in that scenario, customer will be more cautiously seeking your financial statement, so that he has a confidence that you will be able to provide these goods over a longer period. Okay, the third external stakeholder would be public. Now, public interest in your business can be of different reasons. There can be different reasoning for the interest of the public. They can be interest that they want to know the impact on the economy. They want to know your business impact on the environment because you are making some chemicals. They want to know what is the your business impact is on employment, because there's a good chance if you are under the manufacturing industry, the employment margin will be higher for you. Okay, so public interest in your company depends which group you are belonging. If you're belonging towards the environmental group, you will be more interested about the impact of that business over the environment. So it depends where the group is, and the public interest, depending upon their reason, it can be different. But public is an external stakeholder. Then we have a management. Management is an internal stakeholder. Now, management would be very much interested in the financial statement because they want to make informed decisions. They want to make the smart decisions for the maximization of the wealth in the future, because they are the people who is running the business. So they should know everything about the business, because they want to grow that business. Okay, but management is an internal stakeholder. Okay, next type we have investors. Now, investors, why they are interested in your business? Because they want to know what are the profits you are going to give them if they give you some money over the future time. So they will be interested in the future profits, and they will also be interested about the investment security. Maybe the investor has invested some amount in your company, and if he knows that after 1 year you are going to closure, you are going towards the bankruptcy, they will not be confident in investing in your company. So they want to know about the security of their investment. You will be able to pay them back or not after a certain period. When they want to withdraw the investment, you will be in a position to pay them. Okay, so that is why the investor will be interested in the financial statement, and investor is an external stakeholder. Employees are the internal stakeholders, and they will be interested in your financial statement because number one is the main thing which they have in mind is the pay raise. If the company is doing well, they need to have a good pay raise. They need to have bonuses, annual bonuses if the company is doing good, and the job security as well. Because if a company is doing good, it's the employee would want to be having a employment relationship with that business over a longer period of time because the company is doing good. Okay, lenders. Now, other than investors, there are certain institute like bank, financial institutes. They give money to their businesses, to your businesses, and they want to know whether you will be able to keep up with the monthly installment payment, which have the interest part in it, or maybe they are interested after the loan expiry period, you will be able to pay back that loan or not. Okay, so lenders will be interested in the performance of your business because they want to have the surety about the monthly payments and the repayment of the whole loan. Then government will also be interested in your business because they want to know about your operational and financial or industrial policies, because either these policies, your business policies, are in line with the government policies or not. Okay, because government has some governing bodies to see the all the sector businesses in the country. So they want to know whatever your operational or industrial policies you have implemented internally in the business, they are going to check that they are matching with the government policies or not. And the other tax department would be interested in your profit figure, profit and loss statement, because they want to know you have paid this much tax on that profit. So have you have you earned that profit or not? They want to have a surety about that. Okay, so they are cross checking your statement about the figure of tax you have paid to them. So that's why government will be interested in your financial statement. So this will be the external stakeholders. So these are the majority type of users of financial statements or stakeholders, in which you have all the things, and we have considered that in detail.